Man, I love that video. Every time I watch that, I think, where do I sign up? Let's do this. Well, welcome, guys. Glad to have you. Thanks again for joining us. Really appreciate it, as always, taking some time out of your evening to jump on here and walk with us through this exciting deal, Marbach Park in San Antonio, Texas. Great market. Some of you know it, some of you may not. So we're going to talk about that tonight. But again, thanks for joining us. Great to have you. And for those of you who may be a little bit newer, I've got, myself, I'm Robert. I'm the CEO of RM Capital, founded about 4.5 years ago. We currently manage about $500 million in assets under management. I'm here joined with my partner, John, who is our VP of Investor Relations, and then also Adam, who is our VP of Acquisitions. Adam, we requested that he not show up on the screen because he doesn't feel very well. So, no, I'm just kidding. But I told him to please rest up and be on from the couch so he could relax. So thank you, Adam, for joining us. Anyway, so we're going to try to do this. I say this every time and everybody makes fun of me. We're going to try to do this in less than an hour. I was telling John that apparently I like this stuff way too much because there's just all this stuff that I want to tell you guys, and it's hard to condense it down into less than an hour, but I'm going to try once again. So here we go. And also just a quick piece of housekeeping in terms of the platform here, Livestorm, that we use for the webinar. There is a question, a little box for questions, and then there's also a chat. So if you have a question, put it in the questions. If you have any, technical issues, whatever, something like that, throw that in the chat. We try to keep those two separated just so that on the question side, it's kind of nice because it allows us to track everybody's question, make sure it gets answered. Some we'll answer offline. John and Adam help me out with that. Some of them we might do on the webinar as well. So just kind of keep that in mind, but please do put your questions in. If you have any thoughts as we're going through, just pop it in there. Sometimes people don't put questions because they think there's dumb question. There's really no dumb question. We have people that are all spectrum, all points in the spectrum of brand new to multifamily, or maybe somebody that's been doing this for a long time. But you never know when your question could be valuable for everybody. So please pipe it in there. And honestly, sometimes I forget stuff because I've been doing this for a long time, and I forget that, oh wait, not everybody knows what a cap rate is, or something like that. So don't feel bashful about that. So without further ado, we'll jump in here. And like I mentioned, this is a property in San Antonio, Texas, a 304 unit multifamily value add opportunity that we came across probably about 6 months ago now. And it was put on the market by a group that had owned it for a few years, was looking to cycle out of it, kind of a standard flip, if you will. Didn't really do a whole lot to the properties, normal management, nothing to speak of. And so they said, hey, you know what? We've ridden the market, and it's time to take some chips off the table. Now, they were also slightly motivated by their private equity group, who also was interested in getting out of the deal. So again, kind of not a distressed situation, but certainly a motivated seller. The good news about this particular situation, and again, some of you on the call know that we had this ready to close about, I think it was 2 or 3 months ago. And we felt like, just given the market, the increase in the interest rates and where things were going, that we really needed to renegotiate. Now, I say renegotiate and not retrade. In our industry, a lot of times retrade has the connotation that somebody's purposefully taking advantage of either party. And we don't do that. That's not the way we do business. But there are times where the market genuinely moves, and it's just being a good fiduciary to go back to the seller and say, hey, interest rates are a lot higher. Cap rates are probably coming down. Let's talk about this. And so thankfully, a good seller for the most part. We had, some little bit tense moments in there, but for the most part, good seller. Broker was very helpful to get us kind of iron things out. And so we've actually renegotiated this 2 or 3, maybe 4 times. I can't remember all what it's been, but it's been a process. Obviously, you think about somebody with expectations on their end of what they should sell it for. The market's moving. That's kind of life in this business. Sometimes it goes your way, sometimes it doesn't. You just have to be understanding of that. So we were able to renegotiate it. And the most recent renegotiation was a pretty big haircut on the purchase price. We initially started out at the 34 million mark on this deal, which was actually a fair price, good deal. The numbers worked, et cetera. And at this point, we're down to 27, just over 27 million. So it's about a 19, almost a 20% price reduction. And again, that's kind of what we would expect to see or like to see in this market. If you look at interest rates and the relation to cap rates, it's about where things should be. So we feel like it's a fair price. We feel like it was, again, we're not out to gouge anybody. We're out to just be fair, honest business people and do the right thing. So we feel like it was a fair price, and the opportunity is still there. And so kind of on the flip side, we also made the decision, it's probably about a month ago now. Adam and I were kind of going over the underwriting and just, deciding what we wanted to do. The market's moving. Things have obviously changed over the last 6 months quite a bit. And there's some unknowns out there in the market. And so, I just said, I think the right decision is going in this case is I think we need to just lower the leverage even further than what we were at. I think we're at about 70%, maybe 72%. And so we actually lowered the leverage to 59%. We'll talk about that too. And when we did that, it gave us the opportunity to go back to our lender and also renegotiate. And so we lowered our interest rate by about 1.6%. So again, a little bit lower leverage, a little lower interest rate, lower purchase price. And I really feel like, things change. I was happy with the purchase price and the structure we had 6 months ago, but you know what? We're in a completely different market today. So I feel like the structure and the purchase price and everything that we put together today, I'm very happy with it. I think it's put us in a really great position. And the way I kind of look at it is the deal is still the same. The upside for the renovations and the rent bumps are still there. The market is still very strong, but we were able to get the property at a, call it a 5, 6, 7 million dollar discount to what we would have otherwise paid. And so you think about the 3 to 5 year time horizon, and I think everybody would agree, hey, that value is still there. The property will come back. And so we're kind of looking at it as, hey, we're spending a little bit more on interest, maybe 500,000, 600,000, something of that nature over the next 2 to 3 years, but we're picking up a 5 to 7 million dollar increase in the or lower basis, if you will, potential upside in the property. And so, I kind of look at it and say, even if it ends up that we only get half of that, that's still equivalent to a 5x return on our investment. If we're spending $500,000 in interest and we're getting 2.5 million on price reduction at the end of the day, it's about a 5x return. And that's on a really conservative basis. I think it could be closer to a 10x return. So again, kind of a different way of looking at it, but in everything that we do, it's an investment and return. What's our ROI? Does it make sense? Does it help our return? Does it hurt our return? And so in this case, I felt like it was lowering the risk of the property. And then on the backside, we've got some nice return potential for our investment on the interest dollars. So that's kind of the short version. Obviously, we're going to dig into some details, but I just kind of want to throw that out there. And that's really the reason that we wanted to represent this. We've already done the webinar that we did initially, but we wanted to represent it because a lot's changed in the market. And because of that lowering of the leverage, we also obviously opened up the need for more equity. And so right now we've got about $2 million that we're looking to add to this. And obviously the folks that had their investment with us that were ready to go a couple months ago, we have, very appreciative. They're still there. We're ready to go. But we're looking to add a couple $1 million more in order to close that gap, keep the leverage low, and really put us in a great position. So that's really kind of the gist of why we're here tonight. A lot of different reasons, but that's kind of the gist of it. So with that being said, let's see, do I have, there we go, cool. All right. So confidential disclaimer here, this is real simple. It's just basically letting you guys know that this is a 506C offering, meaning that in order to invest in the opportunity, you have to be accredited. If you don't know what that means, feel free to reach out. It's kind of like a basic SEC rule. So we won't belabor the point. All right. I talked a little bit about who we are at the start of the presentation here, but just to give you a little more background, I started a company about 4.5 years ago. We've got about $500 million under management scattered throughout the Midwest, Southeast, and Texas. We are what I would consider more of a traditional operator, long-term buy and hold, focus on cash flow. We are vertically integrated property management construction. We now have a development arm too that is starting to build Class A product. And our focus is really more on the sort of the conservative side of the spectrum. So we're not always looking for the highest return. We're looking for a good return, but then we want to be very tax efficient with that. So at the end of the day, I'd rather be in a deal that returns 16% and I get to keep all of the 16% versus a deal that's a little bit higher risk that may return 20%, but I've got to pay taxes. And at the end of the day, I still have 16 left in my pocket. So that's kind of the gist of our investment philosophy. Now, breaking it down into its components. And I really like this slide because I feel like it really gives you a better idea of who we are. And again, for those of you that have been through this, bear with me for a minute, but we have some new folks on the webinar here tonight. So I just want to go through this real quickly. But there's really 5 components of our what we call a risk-based investing model. Number 1 is stress testing. And we'll talk a little bit about that, but basically stress testing is where you take your deal and then you move some numbers around. You say, well, what if the occupancy drops to 70%? What does my property look like? What if the interest rates go to 9%? What does my property look like? And so stress testing is really important because it gives you the ability, it gives me the ability to sleep at night because I kind of know, hey, even if the Fed raises the interest rates another 2 points, we're fine. Even if occupancy drops and the economy goes to, in a handbasket, we're going to be okay. And so those kind of things are really important when you talk about a low risk philosophy for investing. And again, I'll get into some more specifics as we get further on in the webinar. Number two is identifying risks. And there's basically three primary risks in multifamily. There's cap rate risk, interest rate risk, and market risk. Cap rate risk is a fancy way of saying prices go up, prices go down. Obviously, the risk isn't when they go up, the risk is what if they go down. So how do you mitigate that? Well, one of the ways that we do that is by looking at these investments as a long-term investment. So we're not looking at it as, hey, in 2 years, we got to be out. And if we're not out, the whole business plan's a mess. No, well, what if we're in it for 5? What if we need to ride out the next downturn, come out the other side, we're still going to do fine. So that's a cap rate risk. And that's how we mitigate it. The other risk is interest rate risk, which of course right now is a really hot topic, understandably, because rates are going higher seemingly every month. Well, one of the things that we do typically is we have long-term fixed rate debt. Now, right now, we're not doing that. And on this particular project, we're not doing it. And I'll talk about why. But normally we have long-term fixed rate debt. However, even when we do shorter term, like we're doing with Marbach, we have what's called a rate cap, meaning the interest rate, if the interest rate goes past a certain point, we are not paying any more interest cost. And it's a derivative product that we buy in the open market. And essentially somebody else is taking the risk. We're paying them an amount of money. They're guessing that the rates are going to go up a certain level. We're saying, hey, if they do, fine. But if they go further than that, you're paying for it. So that's our interest rate risk. And then the market risk is the third one to identify. And that really comes down to the neighborhood, the city, the state, everything from politics to business friendly to path of progress to, what kind of resident demographic, all of those kind of things go into the market risk. And again, our job is to utilize our decades of experience to really identify and mitigate, in certain cases, those risks. And so that's why you'll find us in markets that we feel are resilient, strong, growing population, all the kind of things that we want to see. San Antonio, of course, is definitely one of the strongest markets that we're seeing out there right now. So that's number two. Number three is lower leverage. Pretty basic. Hey, the lower leverage you have, the less risk you're taking. Now, we all understand too that if your leverage gets too low, your return is going to be terrible. If you buy this for 100% cash, your return is not going to be very good. You might have very low leverage. You might have very low risk, but it doesn't make sense. So what's the right number? What's the right leverage to have so that your risk is very minimal? And that's something that, as I mentioned, Adam and I sat down and we spent probably half an hour, 45 minutes just kind of thinking about, all right, where are we at in the market? What's going on here? What leverage do we think makes sense given the particulars of this deal? And we just made the decision, you know what? We think 59% is the right place to be. Let's do it. And again, I think it's kind of obvious to say that if you go to 85%, you're way too high. I don't care what market you're in. If you go to 40%, you're probably too low, no matter what market you're in. So, somewhere in the middle, there's a good middle ground, and that's what we try to find. But again, being more on the lower end of that, I think is very important. Number 4 on this list is industry experts. Again, that's just taking our decades of experience and utilizing that in our understanding of the underwriting, the operation of the property, et cetera. And that's something that I think is important because there's a lot of different companies out there, and it's probably more important than anything to focus on the sponsor and the operator versus the property itself. Obviously, we spend a lot of time on the property, but at the end of the day, you really want to look at who you're partnering with. Who are these people? What's their experience? What's their track record? What are their ethics? That's probably actually the most important. It seems like every couple of years that comes to the top of the stack. And I'm just thinking about the whole crypto thing that happened a couple of weeks ago or a month or whatever it's been. It's just, it amazes me how ethics are unbelievably important in any investment. So industry expertise, and then conservative underwriting, which again, I'll talk more about, but just, not being super aggressive about things, making sure to be realistic in the underwriting. And so those are the 5 components that we have identified as our risk-based investing model. Okay, so I want to start out with the executive summary, some of which we've already covered. Then we're going to jump into the business plan, talk a little about the location, property details, and then we'll finish up with the financials on here. So executive summary, really, what's the business plan here? What's the bottom line? Well, the opportunity is that this particular property is below market rent, first of all, meaning there are other properties around us that are renting at a higher level with the same exact finishes. So if we do nothing, we have the opportunity to come in here, provide better management, provide better resident quality that are, residents that are more qualified. And that's a big deal in any property. And typically the ones that we find that are opportunities, the residents are not qualified. Now that takes some time to do, and we'll talk about the time frame of the business plan, but that's an immediate upside. The second component is renovations. This is where we come in, spend a bunch of money. Well, I shouldn't say a bunch, but we spend a decent amount of money on the unit interiors. We renovate them, make them look nicer, and we improve the exterior. Now, this does two things. It attracts a different resident demographic, and of course, it attracts a better quality financial picture from the residents that do show up. So again, these people are willing to pay a little bit more money, then we're able to charge more, and here you go. Now we've got some nice rent upside. So if you look at the chart there at the top right of the screen, you'll see our renovation rent premium comparing our collected rents on the T12 basis, where our market rents are, and then where our renovated rent is. So you can see it's increasing as we go along each of those bar graphs. And that's what we look for, just plain and simple. We look for rent increases based on renovations, and then rent increases based on being below market. Now, the part at the bottom there, where we do a comparable property upside kind of between the properties in the area, is also really important. And I'm going to have some more detail later on here that talks about kind of how those numbers come together. But it's really important to do your homework. And we spend a lot of time driving the competitive properties, visiting them, analyzing the interiors, the exteriors, the leasing capability, everything. We want to know who our competition is, because at the end of the day, that's what our residents are doing. So we spend a lot of time doing that. And really our goal on an ideal situation is we want to be the best value in the market. So if the competition is $1,500, $1,600 a month, we'd like to be 13. Similar interiors, similar, amenities, but we're going to try to provide a little better service. And then if we can be slightly under market, that's perfect. Now, again, maybe after a couple of years, we've done a great job and the business plan is going great. We say, hey, you know what? We think we can push the rents another $100, $200 to get fully up to everybody else. Great. And we've actually done that on several properties that we've owned for a couple of years. But our initial business plan, again, is pretty conservative. So we're just looking to say, hey, let's see what our competitors are doing. Let's do a nice interior finish, provide better management, and come in underneath where they're at. So we should have the ability to really drive that occupancy while we're doing these renovations. All right. So I talked a little bit about conservative financing and underwriting when I talked about the risk-based investing. So here's some particulars on this deal. I mentioned the 59% loan to value. Interest rate, where we're at currently, 7.3. Now that's a little high, as you guys know, because we just had another 75 basis point increase. We're probably going to have another 75 basis points. I'm guessing 50 in January and another 25 in February, if I remember the schedule correctly. So we are going to see some upside there. And again, I've already factored that into the cost of interest. And that's where I said, it's $500,000 to $700,000 of additional interest cost that normally we wouldn't have to pay, but we're getting a $6-7 million discount on the price. So I think it's worth it. Our loan that we're getting on this particular deal is a 3-year loan plus a 2-year extension. So it's basically a 5-year loan. It's a bridge loan, and it's got an initial 3 years of interest only. Now, here's one thing I want to mention, and I talked about it briefly in the beginning. We normally do fixed rate long-term debt. The reason that we're not doing it right now is kind of twofold. Number one, I think the interest rates are going to be lower in a couple of years. So I really don't want to be locked into a high interest rate for 7 to 10 years. I think it's going to make a lot more sense to wait 2, maybe even 3 years, let the interest rates come back down, and then lock in a 7 or 10 year fixed rate loan. I think it's going to be really a really good move from a financial investment standpoint. The second thing is that normally when you do value add, you're adding a lot of value and equity to the property as you're increasing the rents. So from a investor standpoint, you've got a lot of equity that's kind of locked in. Now, we can sell the property. We can, we can do some sort of a supplemental loan, although the agencies have made that more difficult recently. the easiest way to unlock a lot of that equity is to do a refinance do a refinance, which means, you don't have to sell the property. You don't have to worry about a tax consequence, et cetera. So we're kind of putting ourselves in a really good position where 2 to 3 years from now, we can do a refinance at a lower interest rate and pull a nice amount of equity out of the property, give it back to you as the investor, and then keep the deal, keep the cash flow going. It's kind of the best of both worlds. So that's our thinking right now. I would anticipate that, again, within a year or two, as interest rates come back down, we're probably going to flip back to what we've generally done, which is start with a long-term fixed rate loan. But we'll see. That's kind of where we're at today. On the underwriting, so a couple things to note. We are putting in a very large amount of operating reserve money. And again, normally we are at 6 to 9 months. But because of the current economic environment, we've decided to bump to 14 months of operating expenses. So we've got about $2 million in additional working capital. It's kind of I'm almost to the point of saying that it's excessive because, again, we're already stress testing our deals and we're already low leverage. And maybe it's a little bit excessive and we might pull that back over the next, 6 months. But again, just trying to be very careful here. So we've got a good chunk of money that we're setting aside for operating expense deficiencies if needed, or normally it's if there's an insurance claim. We don't want to wait 9 months for the insurance company to approve the claim and get us the money. We're just going to go ahead and spend it, and then we'll reimburse ourselves when we get the insurance money. So there's things that I really like to have that working capital that give us the ability to make good decisions and not be under pressure. Now, the second thing is we've got a break-even occupancy of 70% on this deal. Very normal for us. We stress test year 1 and year 5 with that occupancy test. Now, to just give you a little bit of perspective on that, in the normal downturn, 2008, 2001, you name it, occupancy typically doesn't go below 88% on a national average. So we are stress testing this way past, more than double past what a normal downturn would do. And again, you might say it's a little bit excessive, but crazy things happen and we want to be prepared for them. So that's how we've done that. The second reason that I like to do that is because I really want to know, especially when we're in a situation with bridge debt and we have to be able to refinance in 2 to 3 years, I want to know, worst case, are we going to be able to refinance that loan? And so in this particular deal, and actually I don't see it here, but I actually stress tested it to like a 9% interest rate at a 55% loan to value, and we still were able to refinance our loan. So basically, the entire world can fall apart, barring World War III happening or something crazy like that, and we're going to be able to refinance. So again, that kind of comes down to our level of conservatism. We just don't want to risk our capital. All right, so if we put all that together, what are we looking at from return standpoint? And there's a couple terms on here that I'll explain. So there's a preferred return of 8%, and essentially what that means is we, as the sponsor, do not get paid until 8% is returned to the investors. So it's kind of a hurdle. It basically says, hey, our commitment to you is that you're going to get 8% before we get anything. Once the 8% is achieved, then we're going to split it, and you're going to get some, we're going to get some. Obviously that's our goal. We want to make some money off of this too. But it's kind of our commitment to you as the investor to say, hey, first 8% is yours. Now, it's not a guaranteed return, and some people get that a little bit confused. It's not a guaranteed return. It just means that it's a preferred position, meaning you get that 8% first. And the reason I say that is because in all of these value add deals, the returns start off lower in year 1, and then they kind of bump up as you go along. Especially in year 1 and 2, it's a little lower because we're doing that renovation. We're kicking out some residents that shouldn't be there. We're bringing in the better ones, et cetera. So the preferred return usually isn't hit until year 3, maybe year 2, but just to be safe, I'd say year 3. Now, the beauty of it is that because it's not, it's a cumulative return, that return has to be made up. So even if we don't hit it in year 1, we're going to make it up at some point year 3, 4, and 5. So again, that's just kind of our commitment to you. Overall, the cash on cash return, our projected average cash on cash return is in the 11 to 13% range. And normally we try to target 10 to 15. So 11 to 13, right in that range. Our goal is at the end of the day, we want to make sure you're kind of in that range because we feel like that's a good number. And our projected IRR, which is our kind of like a compound annual return, internal rate of return, whatever you want to call it, 16 to 19%. Our goal for this is 15 to 20. So it's right in that range. And generally speaking, if you're in that 15 to 20%, plus or minus, you're basically doubling your money every 5 years. And that's an average, conservative average in our industry. So, recently people have been doubling their money in 2 years, 3 years, sometimes 1 year. It's ridiculous. That is not the norm. And I have a feeling that for the next few years, that's definitely not going to be the norm. It's going to be a little bit longer. But if you look long term, doubling your money in real estate over 5 years, that's a very solid return. Again, you got to think about the risk you're taking to get that doubling. So again, if you've got low leverage, conservative, experience, et cetera, and you're still able to hit that, you're in pretty good shape. The investment term, I tell everybody 5 to 10 years. I think 5 years is kind of a really good number to work with. I say 10 only because, 5 years rolls around and we're kicking off 16, 17, 18%. I don't know, it might be hard to replace that investment. And so we're always thinking about the replacement cost of an investment. And at that point in the market, maybe 5 years and we're getting 17% every month on our distributions. And we may look around and say, wow, everything around us is paying like 5, 6, 7. So it doesn't make sense to sell. So you definitely have to think about that. And then you also got to think about the tax consequences too, where, if a particular deal is doing great and you've got a huge amount of capital gains built in, you don't want to sell that property until you have a replacement property. And that's something that we really focus on, is making sure that we've got a replacement property so that none of us are having to pay taxes at the end of the day. We can roll our investment into the next deal and really continue to grow the equity. So, and then the minimum investment, pretty standard here, is $100,000. That's pretty standard in all of our deals. And no, John, that was not beer. That's Pellegrino. Hopefully I won't lose my voice like I did last time. All right. So, I mentioned a little bit about the business plan and the timing. And it's, I say it's a 2-year process to cycle through the full renovations, et cetera. We generally give ourselves 36 months from an underwriting standpoint to give a little fudge factor in there. Our goal is to hit 24 months, but our underwriting says 36. So again, building in fudge factor and being conservative is really important. So in that first 18 to 24 months, the main focus here is the renovations, exterior, interior, couple things we want to do: pool and playground area, barbecue pit, things of that kind of that nature. We've also got 16 brand new units that are being completed as we speak. They're just about done. And it's the building that's right across from the main clubhouse. So great thing about that is we actually underwrote that it's going to take us 2 years to get all of those units filled. I can tell you from personal experience, it's probably going to take us about 3 to 6 months, because people are going to absolutely love those. They're 9-foot ceilings. They're, beautiful. It matches on the exterior, but of course the interior is like a Class A finish. So those are going to be a piece of cake to rent up. Obviously the rents are going to be a little higher too, but again, it kind of gives us a little bit of buzz in the community and brings in some folks that might not otherwise look at the property. So we're excited about that. And of course, somebody may come in and say, well, I feel like the rents for this brand new building are a little bit too high. And we say, great, hey, come on over here and look at the renovated units that look pretty close. They don't have all quite the brand new smell of wood or whatnot, but you know what, they're going to look great, and you're going to save $300-$400 a month, $500 a month. So again, that kind of gives us a little bit of marketing ability there. And then of course, once we're done with the initial 0 to 18, 0 to 24, then we're going to go to that refinance period where we're going to start pushing the rents more up to, market rents, finish some of the exterior improvements if we need to, and then really look to do that refinance at that time frame. I put a couple pictures up here from a previous property just so you can kind of understand the general look of what we start with and what we end up with. For the most part, our focus right now is something that is probably familiar to a lot of you. It's called modern farmhouse. It's a very highly sought after look, especially, well, I shouldn't say especially in San Antonio. It's kind of nationwide, honestly, all the way from the Northeast to the West to everywhere. So it's a look that we just thought, hey, a lot of people in the multifamily business are sticking with the tried and true brushed nickel, nice countertops, et cetera, et cetera. Absolutely nothing wrong with that. But I think the modern farmhouse is probably going to last a while. There's nothing functionally obsolescent about it. And so we've been putting it in on all of our renovations, and we've had a tremendous response. People absolutely love it. And it's not that much expensive. In fact, in some areas, it's less expensive. So that's our focus right now from a design standpoint. It's really been received well in the marketplace. And so that's what we're going to be doing with Marbach Park also. Okay, so I talked about the rent comps earlier, and this is a little bit more of a breakdown on how we look at this. And this is super important because, again, it's one thing to say, hey, I'm going to put in $3,000, $4,000, $5,000 per unit renovation, and I'm going to charge $500 more. Great, love your business plan. Can the market support it? And that's where this becomes really important. You want to look at rent comps and then also look at average median income, because people have to be able to afford it. And then people also have to have a reason to come to you versus the competitor who may have a better deal. So that's why we really look at rent comps. And you can kind of see here a little bit of the thought process. So we look at properties that are at where we're at today. We look at properties that are renovated, and then we look at properties that are above where we are today. So maybe properties that are newer vintage but have not been renovated. And so our thought process is, okay, so we're not going to be as new, but we're going to have a nicer finish. Or we may be same vintage, but we're going to have a much nicer interior. How does that compare us to the market? And then try to get a sense of where does that mean we're going to be in terms of overall cost. So if you look at where we're at today on, let's just say the one bedroom, and we're at $800 for a 622 square foot one bedroom. In the market right now, people are paying anywhere from 13, 15, all the way down to what, 879. So basically everybody in our market, even the properties that are older, unrenovated, are getting more than we are. So again, that's where the market rent bump comes into play. But let's compare ourselves to some of these folks that are newer, have been renovated, et cetera. Well, they're up at 13, 14, almost $1,500. So we're basically saying, hey, let's go to $1,100 for our units with a renovation package, with upgraded exteriors and interiors. And we think this is a very achievable number for our one bedroom units. And we do the same with the 2 and the 3 bedroom. But that's basically the thought process. Now, remember, when we did this analysis, it was 6 months ago. Since then, rents have gone up even further. And I know there's some talk about rents coming back down, et cetera. Well, I can tell you this, in San Antonio, it's not quite that. The rents where we've seen some challenges is, trying to think recently what I read. I was going to say Florida, but actually there was a report that came out just the other day that said South Florida is still on fire. So yeah, there are certain, I mean, again, we're looking at a national average here when you see these headlines with rents coming down, but it's not happening in Texas. Again, I think places that have population growth, San Antonio being one of the top markets, it's going to be tough to have rent declines in a market where people you can't keep up with the number of people coming into the market. All right. John, I'll let you talk a little bit about the market. I know that's kind of something that you've done a lot of research on.
Yep, absolutely. Happy to. We'll keep it short. A lot of people have heard plenty about San Antonio and Texas in general, and we want to leave a little bit of time for questions. But some things I added since the last time we talked about the property, I felt that it was really pertinent to mention that there's the San Antonio Economic Development Fund is looking at a $55 billion economic development plan. That's going to bring a lot of jobs, 140,000 more jobs to the area. Last year, San Antonio led the nation with in-migration, which was pretty impressive and surprising too. A lot of people would think it would be a couple other, well-mentioned metros in the U.S., but San Antonio took it. Ranked number 2 in the U.S. for best cities for conferences. It's a very business-friendly state and a business-friendly place to travel. And we'll talk about this a little bit later too. There's a lot of companies that are moving into Texas and to San Antonio as well. So also ranked number 9 in the country to visit. Every time I've been down there, I've really enjoyed my time. And I think that Robert's actually trying to get me to move down there to get more involved on the construction side of things too. But anyway, so
you never know. I might move there too.
Right. Yeah. So I wanted to do an aerial just to orient yourself as well as far as where the asset is located. You'll notice just at the bottom of the property on that corner there, it says Lake Vista Development Project. Robert, that's our development project. It's just 6 minutes down the track, and we're going to be doing a Class A development there, which is great because we really do believe in San Antonio. We're going to have a long-term play in San Antonio, and for us to be vertical on a nice development project just down the road says a lot as far as how long we plan to be there. So
well, and obviously too, sorry to interrupt you, but it just, path of progress. That's really what's happening on the west side. So again, we feel like Marbach Park is right in that path of progress. Obviously, the demographic for a Class A is different than this, but the point is, a lot of people are moving in that direction.
Sure. And I think traditionally this 410 kind of loop, if you will, was looked at as pretty far out, but that 15-minute drive to downtown and to the airport, it's very convenient, and it's grown well beyond that, probably out to this next highway out there on the
1604 is now the not even the loop. There's one further than that, but 1604 is definitely now kind of like the main loop that runs around. Yeah,
absolutely.
So, yep.
Okay. So this is an interesting one, just from sales pricing, get an idea about San Antonio and what it's doing. A lot of people talk to us about, well, what's the basis that you're stepping into the property with, and the price per door, right? And this is an interesting graph here because the yellow line is San Antonio. It's been a value comparative to multifamily in the greater U.S. But, we're really taking this property at a, what do we call it, 2012 to 2013 value overall, which, that's going to be pretty amazing when you get, into the business plan, execute the business plan, drive value at the property, and let the market do what the market's going to do in San Antonio. So wanted to mention that. Median household income in the area, 44,000. This is the immediate area that I'm speaking towards. Younger demographic as well at 34. So why that 44,000 in median household income is important, because when you start getting about 32,000 or lower, your delinquencies go up, and it's a little bit more of a problem. It's a harder asset to manage. So in the neighborhood, we're talking a $295,000 median house sale price. And Robert already touched on this, but that is such an incredible delta from the average area rent at $1,139 and where we're at currently at Marbach. So really key point I wanted to hit home on there. Okay, Bexar County. I got that right, Robert, correctly?
Yep.
It's not Bexar.
You always know the newbies.
Yes, absolutely. So, again, towards management, we wanted to mention here, we're always looking to start out, depending on the asset, at a 2.5 times rent for the required income to get into the property. And we do try to move towards that 3x. So here's just some quick math here in regards to how that correlates to the submarket for income compared to where we'd be at for that 2.5 times rent just today. And of course, in the future, that will continue to change. So a little bit more about employment and different sectors of the employment. And I wanted to point out here too, that the Air Force Base is here, and people say, well, gosh, you don't want to be over leveraged towards the military. There are a lot of other things going on in healthcare, in finance, in tech, quite a few things happening in the area. And I always look at the construction and that sort of thing, because you don't want to be over leveraged into construction too. I always hit on that point, and it's at a very reasonable rate there too. So anyway, next slide here. This is what I mentioned earlier, just what's happening in Texas in general. 62 corporate relocations into Texas in 2021 alone, coming from 17 origin states, and 25 corporate relocations from California, which is pretty impressive. Population growth, whether we're talking about the last 10 years, the next 5 years, the next 10 years, or into 2060. I've seen reports. It is just amazing about how many people are moving into San Antonio. So, okay, Robert, thank you.
Beautiful. Thank you, sir. Appreciate it. One other quick note while I'm on this kind of overview slide too, as John mentioned, one of the key elements here for us, I think in any investment, is just trying to find locations where everything is moving in the right direction. Both the property itself has got, good upside. The area around it has, things moving in the right direction. And then the city has people coming in and interest, high levels of interest and population growth, et cetera. And that's what San Antonio is. So, and this particular deal too. And one of the things on this slide too that we're pointing out is this $250,000 new home neighborhood that just went in recently. That again, that's the kind of investment that we like to see in an area around where we're about to plunk down a big chunk of money, because obviously people are moving into the area. It's being revitalized. Great access to the interstate, great access to jobs, everything that you want to see in an area to really take it to the next level. So that's something that's super important for an investment thesis. It doesn't mean you can't make money if you don't have that. But again, why not? Why not go find the property that has everything, all the wind at the sails, so to speak, and everything lines up. So that's the goal here. From a unit mix standpoint, we've got 1 and 2 bedroom units on this particular property. There's no 3 and 4s. So it's kind of more focused on young professionals, small families, et cetera. Again, nothing particularly functioning obsolescent about. That's just the property. And then let's jump into the financials. So how does this all look for you as an investor? Well, this is pretty standard, I would say, for an investment of the type of value add stuff that we do. So year one typically is about 4 to 6% for cash on cash return. So if you invest $100,000, you're going to see between $4,000 and $6,000 year one. Now I projected 4.1% on this particular deal, partly because again, we're trying to be a little extra conservative given where we're at in the market, a little bit of unknowns out there with regard to the economy, et cetera. Year two, we're about 5.76%. Year three, we're projecting close to 7%. And then we do the refinance. So you're going to get a $75,000 check back in year three. It's our projection. We'll do the refinance, and then the cash on cash jumps way up to 21%. Now, something I want to point out, because there's a little bit of confusion here. The percentage of the cash on cash goes up because we've been able to take a huge chunk of our capital back out. Now, if you just take that capital and you put it in the bank and don't do anything with it, you kind of miss the whole point. The idea is take that capital, reinvest it in the next deal, get another cash flow stream. And if you take the two of those together, your dollars, your absolute dollars that you're getting should always increase. So you might be getting 21.5%, which equates to $5,300 in year four on Marbach Park. But let's just say you reinvest in another deal similar to this. Well, if you add $5,300 plus another 4,000 to 6,000, you're actually at 11,000. So if you think about it from a total return standpoint, you're getting 10, 11, 12, 13. Again, you're kind of in that 10 to 15% range. And that's really the goal of the investments. They don't happen overnight. It's not a get rich quick scheme, but if you really stick with it over the long term, it's absolutely amazing how these models work and how tax efficient they are. So that being said, this model is based on a sale in year 5. So we're saying, hey, what if we cash out, go home, we're done? Again, we're not going to do that unless we have a replacement property, but that's our projection. Number 2 is, even if we don't sell, we want to make sure that by the time year 5 rolls around, as I mentioned, all of the initial capital has been paid back. So the $75,000 plus the distributions is in excess or equal to that $100,000. So that means that when we get to year 5, we may say, hey, we've got all of our equity out of the deal. There's no more risk involved. If we keep it, great. We get cash flow. We don't need to sell it, but maybe we do, maybe we don't. But we can take our money, reinvest in the next deal. And again, that's kind of the ideal situation. That's really where you want to be for long-term appreciation and cash flow. I talked a little bit about the purchase price earlier, $27,350. The working capital, I mentioned the $2 million. The two items that we didn't really go over in super detail was the CapEx, the renovations and the interior renovation and the exterior. So we've got a little over $3 million here budgeted between interior and exterior renovations, which is a pretty healthy amount. Normally it's not that much, but it's a little bit of an older property. There are some deferred maintenance items. There's a fair amount of work that needs to be done on the interior, and we wanted to make sure we gave ourselves enough room to get that done. So we've got a good chunk of money set aside for that capital improvement. And then our closing costs are always a little higher with bridge debt versus agency. So they're a little bit higher here. It also includes a rate cap. As I mentioned, we're purchasing a financial instrument that will limit our potential exposure from an interest rate environment standpoint. So again, we're paying a little bit more there, but that's our total money going in. And then we split it up between equity of 15 and debt of 19 million. So again, you can see it's a pretty conservative setup there from a debt to equity standpoint. This is a little bit more detail on the 1.7 million for the interior renovations. And then I've got another slide here that details the 1.5 million. We'll send you these slides so that you can take a look at them in more detail. I'm not going to break it down for the sake of time tonight, but that's your detail. And then I do have another slide here for the investment pro forma that goes through year 1 through 5, detailing what our assumptions are from the gross potential rent, vacancy, loss to lease collection, utility, other income, utility, trash, other income, that kind of thing. And then I've got another slide here that talks about the expenses. Same thing. Now, the one thing I want to point out that's happening in the market right now that's a big factor for us. Rents are really strong. I mean, even in today's market, rents are very strong. We don't really anticipate a whole lot of weakness there unless the economy really, I mean, it would have to be a lot different than 2008. And one thing I will mention that I think is really important to note, we are not in a financial crisis right now. This is not a financially driven situation. This is that's what I meant. So basically right now what we're in is a situation that has been created by the Fed, excess liquidity. Now they're trying to pull it back out. So the underlying fundamentals of the economy continue to be very strong. And everything that we're seeing coming out continues to support that. So the question is, how do we achieve a soft landing in the economy without destroying a lot of these underlying fundamentals? And that's really the key here. So we're trying to be careful about that. But, things like, as an example, payroll, wages continue to go up. So we have to factor that into our underwriting to make sure that we've got the appropriate amount factored in. Same thing with insurance. Insurance rates continue to go up. So we've got to factor that in and make sure we've got that covered. Those are probably the two biggest things. Taxes are usually pretty easy to estimate, and we're pretty conservative about that. We kind of assume that after 2 years, it's going to go to 100% of value, unless we have a tax attorney that says, oh no, you've got a better luck at a lower rate. But normally we're pretty conservative on that. So again, those are the kind of things that are happening on the expense side. And I really believe that at the end of the day, we're going to be able to pass through all of that to our residents, because unfortunately, that's just the way it works. Costs go up and it gets passed through. I've got a slide in here again. I'm not going to go over this slide for the pro forma assumptions, talking about all the details. So if you really want to dig into that, it's all there, and we won't go over it tonight. Now, on our FAQ slide, I talked about what a preferred return is. So you got that. I won't re-review that. But can I invest with the money with an IRA? We got people that ask that question every time. Absolutely. IRA money is a great way to invest. There are a couple little nuances that you have to think about down the road, but again, it's vastly superior to not investing at all, of course. And then there's a couple companies that we list there that we work very closely with on the IRA side. If you have any questions, feel free to reach out to myself or John, and we can kind of direct you there. But great opportunity, especially in today's market, with kind of where things are at with the stock market, to diversify the portfolio, get a little bit of a rebalancing in your overall risk diversification. I just think it's a great thing to do. So if this is a new type of investment for you, definitely would encourage you to learn more about it. And again, we can help you with that. The last thing on here, which is really important, are we doing a cost segregation study? Absolutely. We do a cost segregation study on every property that we buy. Some of you may be saying, what in the world is this? Well, basically what it comes down to is we are allowed to get an engineer combined with a tax person, a CPA, and break down the components of each property into their class life or their useful life. So a door, how many years? Okay. Wall, brick, siding, etc. Break it down into the useful life. And the IRS says, hey, as long as the useful life is under a certain time period, you can accelerate or take all of that depreciation in year one. It's called bonus depreciation, or accelerated depreciation. So it allows us to take huge non-cash tax losses in the year of our investment, pass them through to you as the investor, and you can then use them to maybe offset some of your current income, but more likely it means for the next 5 to 7 years, you're not paying anything on your distributions. Maybe longer than that, but usually 5 to 7 years is a pretty good amount. So again, it's a huge tax bonus. Now, one thing about 2022, this is the last year that we're going to be getting 100% bonus depreciation. This law was set up back in 2017. It was to run for 5 years, which is 2022, and then it was going to start to what they call sunset. So it's going to phase out. So 23 will be 80%, then it'll go to 60, 40, 20, and then 0. So again, next year we'll still have 80%, but this is the last year to get 100%. The last year to get the biggest bang for your buck when it comes to tax depreciation. So I always like to mention that because, again, I don't want anybody to come back and say, oh man, I didn't know. We always try to keep our investors educated so you can make an informed decision, both from an investment standpoint, but also from a tax standpoint too. Not that the tax tail should wag the dog, so to speak, but of course that comes into play because, if you can save $100,000 on taxes while you're making $100,000, that certainly affects your overall return. So, all right, so that's kind of the conclusion of the webinar for Marbach Park. But we've had a lot of questions in today's market that we wanted to just kind of throw out there. And again, John, if you've got other questions you're seeing in the chat, we can add them in here. But just a couple things. So we've had people say, can you kind of speak towards rent growth assumption, exit cap rate assumptions? Basically, what are we doing here? How are we adjusting for the market? Well, we've never actually assumed rent growth assumptions in our renovation process over the first 3 years of the deal. And this goes back from the beginning when we started. So we didn't just start this, 6 months ago. We always assume 0% rent growth. So all the rate growth that's happened in the last, 10 years for us is bonus. We don't need it. It just gives us extra upside, extra fudge factor, whatever you want to call it. And again, I think that's the right way to underwrite it because it gives you room to maneuver. It gives you, the ability to, oh, you know what? Property insurance went up a little more than we thought, but rent growth went up 2%. Okay, great. That offsets each other. So that's kind of how we've projected it. Same thing here. There's no rent growth for the first 3 years. After 3 years, we assume a 3% rent growth, which actually is the long-term average for multifamily. On the exit cap rate assumptions, which again, that's our assumptions for internal rate of return and what kind of value we're assuming at the end of the day. On this particular property, we've actually assumed over a 5-year period I believe it's a 1.5 point increase in the cap rate. Now, if you take the average change in multifamily cap rate versus the increase in interest rates, and this is going back 20 years, I believe, to see a 1.5% increase in the cap rate, you would need to see a 4.5% increase in the interest rate. Now, right now we're at 3.75%, probably another, 375 basis points. We're probably going to see another 75. So that'll put us at 450, right? So basically we've factored in the maximum already on an exit cap rate assumption. So we're assuming that in 5 years, when we exit this property, we are going to be at the same point that we're going to be in first quarter of 2023. Now, if you think that, I think you're being a little bit overly pessimistic. I don't think that. I think a year or two, we go through this correction, recession, whatever it is, we come back out, we're going to be in a much better place in 5 years. So again, I think it's very conservative on our exit rate, cap rate assumptions. We're not really baking in any of the upside that I believe we're going to see over the next 5 years. And again, we all have short-term memory. If I look back 5 years, I'm like, wow, can't believe what's happened in 5 years. Same thing. It always looks better or worse depending on where you're at in the short term, and it tends to be less in the long term. Another question was
I'm going to jump in with another question here.
Yeah.
From the audience. Yeah. So Patricia wanted to know about what we would consider the buildings on site currently, as far as the class of the asset and the surrounding neighborhood and what that looks like just from a boots on the ground perspective.
Sure. Well, I would consider it a C property in a B neighborhood. So
I'd agree.
And that's what we generally look for. We want to see some up and coming areas around us. So we're not the A class in the B neighborhood. Obviously, that's not a good place to be.
Great.
Okay. So another question was, how do we approach property insurance with the assets with an increase in cost? So one of the things that's really important in property insurance is knowledge of the market. So we spend a lot of time finding insurance guys that know the market, know how to underwrite correctly, and they know how to sell the actual deal. So I know it sounds like, here's my property and, here's the information, and you give it to the insurance guy and he kicks you back a quote. Not so fast. This is not like your single family home. There's a story, there's a business plan that goes behind it, and the insurance company cares about that. They want to know, what are you investing in the property? They want to know your experience. They want to know, hey, if you've had crime and you have a plan to, put up a gate, hire a security guard, key card everybody, oh, wow, that makes a huge difference. Yes. And if you can show us that you did that on another property and it decreased the crime to nothing, that's a big deal. So again, there's a story that goes into it. So we spend a fair amount of time focusing on that, and that really helps us decrease our increases in the property insurance. Now, we're still seeing a fair amount of increase, but I will tell you the other day, kudos to Adam. He actually got a quote for one of our properties that was 40% less than what we had pro forma'd initially. So again, the opportunities are out there. You have to go find them. Like anything, you can't sit on your rear end and expect success. So,
Robert, that was 40% of the quote, 60% less.
Oh, 60%. Oh, wow. Goodness sakes.
Just saying, Robert.
Sorry, that was a big difference. Had to mention it.
Thank you for jumping off the couch. I appreciate that. That's dedication right there. That's great. I appreciate it. But anyway, I guess my point being that, it's like anything, you got to go out there, you got to knock on doors, and you got to make it happen. And I'm not trying to say that, we can do anything, but it's certainly property insurance is a challenge. So we're pushing on it. And again, Adam's taking the lead on that and doing a great job. So the next question here, how are you specifically stress testing the deal? We really talked about that in terms of break-even point, interest rates, a refi, that kind of thing. And then why it's a good investment today, given the current macro environment. So I'll talk about the second part of that question more so. The reason that I think it's a good investment today, given the macroeconomic environment, is that we are in a long-term undersupplied situation with housing. There are 5 million units, plus or minus, depending on who's counting, that need to be built in order to just satisfy the existing demand in the housing market. 5 million. Now, if there was massive overbuilding for like 5 years, we might be able to catch up. There won't be, because this downturn is going to make people just as scared and remind them of 2008 all over again. So more people are going to sit on the sidelines and say, you know what, we'll just take our time. So again, it's not changing anytime soon. And that's a huge tailwind, if you will, to what we're doing. If you're interested in kind of getting really detailed about it, there's a Q&A or monthly, what do we call it, John? Monthly educational series.
Yes.
That we did a couple weeks ago, I believe. And again, it's about an hour long. It's a lot of detail, but I actually did a pretty in-depth analysis of where we're at and why I think this is a good environment. So I'm pretty sure you can find it on our YouTube channel, but I really walk through all this stuff that we're seeing. We'll probably do another one in 6 months just to, we got so much data to work with here these days. But anyway, so yeah, we really believe it's a great environment. I'm not just saying that because we have a deal that we're trying to close, blah, blah, blah. I mean, look, we've got all of our money invested in this thing too. So I'm not trying to put myself in a situation that I think is stupid. I really believe the value that we've gotten, the discount in price, makes a lot of sense. Obviously, you got to have liquidity to get yourself out to the other side so that you can see the upside. And that's why we're conservative for our underwriting. And that's why we have the $2 million of working capital. So how can I protect my money during a recession? Well, I think there's a couple things. One is if it sits on the sidelines, generally speaking, you lose. If you're in an inflationary environment, you definitely lose. And that's where we're at today. So where do you want to put your money? No matter what it is, you always want to put it in a hard asset, something that's physical, I think. But even more so, if you can put it in a hard asset that also cash flows, that's the win-win situation. Because in an inflationary environment, hard assets go up. And if you're getting cash flow off of that asset, you can pay for it. So again, whether it's multifamily or something else, a hard asset that cash flows, I think, is the place to have your money no matter what. But I think certainly during a recession, it's a great place to have it when you're in the middle of an inflationary environment. So that's just my 2 cents. I really, the 20 plus years that I've been involved in multifamily and commercial office space and just real estate in general, I've seen it time and time again. And again, it really comes down to the operator, whether they're properly capitalized so that they can weather the storm during the recession. But if you are, you're always going to make money. Are you reducing distributions on other deals? Great question. No, we are not. We had the same question at the beginning of the pandemic. Same thing. I was a little bit shocked. I'm like, well, why would we reduce our distributions? We're the market's still great. And that's kind of where we're at today. The market's still great. We're still working hard to make sure we turn these properties around. The only challenge that we have is the challenge that we expect when we take over a property, which is, sometimes we expect 30% of the residents need to go and it ends up might be 70%. You just never know. So, it takes a little bit longer maybe to get the whole turnaround project done. But yeah, we really don't reduce distributions on our deals. And again, part of the reason is because I don't see our role in this relationship as being one of, hey, invest with us and let's hope for the best. That's not a professionally run real estate investment shop, in my opinion. So we kind of look at it as it's our responsibility to ensure that your distributions are consistent, on time, and relatively realistic. So, if I said, hey, you're going to have 12% out of the gate tomorrow, wonderful, great. Well, that's ridiculous. That gets you in a Bernie Madoff situation, which, nobody wants to be there. So our goal is to be realistic, to be consistent, and at the end of the day, to provide you with a low risk, solid return deal that, you can continue to count on and it rolls forward and, we all do great at the end of the day. So anything else, John, that I might've missed or you saw in the Q&A?
On that note, Karen was asking how much does REM Capital typically invest into deals?
Great question. So on this one, I believe we're at it's $1.5 million or $2 million on this one, which that would put us at 10 to 15%. That's about right. Yeah.
Yeah.
Normally we're 10 to 20% on all of our deals pretty consistently. Once in a while we'll go less than that. And really the reason for that would be because let's just say we've got 3 or 4 deals we're trying to close at the same time. We may want to pull some of that money to put it into escrow for the next one. I mean, there's times where I've had, $6-7 million tied up in just escrow money. So,
and a lot of it is non-refundable in this last market as well, right? And I think that's an important part to take on. And also, Robert, on that note, you could talk about for every $100 million of assets under management, what you and the general partnership are doing for liquidity.
Yeah, that's true too. Yeah, we've kind of just made a personal decision, I guess, if you will, that for every $100 million of assets under management, we're setting aside an additional personal REM capital, working capital of another $1 million. So that's just kind of, again, I don't know. Like I said, been in the business a long time. I grew up in the construction business. My dad owned a home building company, and I'll never forget him talking about how in the Dallas market where I grew up, there were, I think he said like 10,000 builders before the S&L crisis, and there was 1,000 afterwards.
Mhm.
and he was one of the 1,000. And it may be 1,000, 100, but I think it was 10,000, 1,000. Anyway, bottom line is, you win consistently by being careful and having liquidity. And in real estate, it's very important because there's leverage. And so again, that's a big pillar of how we operate. So, all right. Timeline. So yeah, or contract early June. Yeah, it has been 6 months. That's amazing.
Right.
All right. So forget the June. We're here today, December 6th. So webinars today. We're closing on Thursday or Friday. Adam's trying to get me closed Thursday. I don't know. I might just kick it to Friday just to, happy hour. No, I'm just kidding. Anyway, so closing coming up this week. And then first distribution will be February 15th. And then every month thereafter. The delay between those two is simply because we like to allow for a full month of operation, which in this case would be January before we kick out the first distribution. Just because, there's accounting and getting things up and running, and it usually takes a few weeks to get that up and running. But anyway, so that's kind of where we're at today.
So quick
John.
input, Robert. I was going to say, you mentioned about $2 million in space because of the deleveraging and whatnot. We actually have 1.8 now as we're speaking.
Okay.
And just because there is such limited space and time, I would say just go ahead and email us both, either Robert at REM or John at REM Capital,
Sure.
and make sure that we start communications and we can get you sorted out pretty quickly.
Absolutely. Yep. And for those of you who have a login to the portal, first you can always go in there and make your reservation too.
Yep.
Yeah, hopefully we can get it wrapped up. Would love to have you. And again, for those of you on here, appreciate the time. It's always great to connect. We will keep you posted as the next few days go, and look forward to seeing you on the team. Until then, have a great evening, and take care. Talk later.
Take care.
See you guys.